All right, everybody, welcome to a Wednesday session. This is Wednesday, October 9th, and we're trading here in the afternoon. We're going to look at some charts together. I'm here with my live trading room, and if you have an interest in joining us in the live trading, you can go over to drstoxx.com. That's drstoxx.com, and click on the live trading room button, and you'll be able to sign up there and join us here in the live room. You're going to get all the trades that I take throughout the day. You're going to get my entry price, stop loss, target price, reasons for the trade, updates along the way, and sessions like this where I go over some charts and stocks that we're in, stocks we're interested in, and I take chart requests, among other things. All right, so let me go ahead and get over to some charts. Let me move this over here. There's our StockTwits thread. So if you don't follow me over on StockTwits, you can find me dr_stoxx. I'm also on Twitter. Same moniker is without the underscore, drstoxx. And I post charts there throughout the trading day. So let me take a quick look at PLTR. I just mentioned this in the room, and it is off to the races. I learned, in fact, today that it is a so-called a Trump trade, which is to say it's a company that would benefit better from a Trump administration than a Harris administration. And I didn't really know exactly why, and I don't know that much about the company other than the market loves it, and it's legging into AI in such a way as to make it competitive with some of the bigger players in the space. That's about all I know about PLTR, other than some very good growth numbers. But it also has big contracts with defense industry, so that's probably why it's getting a good boost here. Trump has been rising in the polls, and Harris has been falling in the polls, and so that may be reflected here. But anyway, it's a great trade. So I have my I have an options letter that I've been managing for several years over on MarketFi.com, and I have my members there in some January calls at the 50 strike, and man, doing really well with that position. All right, but let's go back over to indexes, and we'll take a look at SPY. So I put these yellow boxes around areas of very, in fact, I could probably put another box right here. Areas of fairly tight, choppy, trendless price action. Up one day, down the next, up 2 days, down the next two, and so on, trading within a fairly tight trading range. Lots of confusion, not a lot of direction, sloppy movement in the moving averages, and we've seen a lot of that. We've seen long stretches, anywhere from 5 or 6 sessions to 15 to 18 sessions. If we could go back further to the October bottom, we would see some of that. And we're in one right now, but as of today, this would be the second day of upside, second day of very good upside. We're breaking out of the most recent trading range or trading box. So that's very good. Good to see. The S&P is right now, as we speak, at new all-time highs. It has never been higher than this, and that means that companies have never been as richly valued as they are right now. Does that mean that the country is at the strongest it's ever been economically? Not necessarily. Not necessarily. And the reason for that is because, at least in part, the S&P 500 is a weighted index. The biggest companies in the world are right there at the very top. And we've seen a lot of those big companies leading the market higher without necessarily a lot of participation in a lot of the smaller companies. So when you start to look at the broader economy, you're not seeing an economy that's firing on all cylinders. You're rather seeing an economy that has a handful of very strong companies that are huge and getting huger. And that's what's driving this market higher. So if we're going to sustain this move, and I think we probably will, we'll want to see broader participation. We'll want to see some of the small caps coming into play. We'll want to see the regional banks start to catch a good bid, the biotechs, the home builders and their supporting industries, some retail plays. We've got a number of big retail growth plays that are just down near the lows of the last 6 months or so, and they have just not gained any traction. So anyway, I'm thinking there of Lululemon, I'm thinking of Celsius, and some others. But if they start participating, and I'm especially thinking about the regionals, the biotechs, and I also would like to see the bonds catch a good bid, because that usually is supportive of the desire for corporate investment, then we should see this breakout today get sustained. So we're not there yet, but this is a very hopeful sign. Volume has been light, I have to say. We're down about 40% below average volume today. That's not a real good sign either, but it's not a deal killer either. So if the recent pattern holds, we will probably see a down day tomorrow, and we might even close the week on Friday in a very negative state. Now, we've also got CPI coming out tomorrow. If that comes in anywhere above expectations, we will likely see some sell-off. And then we've got PPI on Friday, which is kind of like the same sort of read. CPI is a read on inflation for consumers, PPI read on inflation for producers, and it's both inflation, either one. Both of them are reads on inflation. So lots of good reason why we can't get too hopeful here on this breakout, but it does look good. I have to say, it does look good. Now, we've seen these little breakouts before. So, back here, new all-time highs. Very next day, way down, right? That was a massive slide. We saw this day right here, nice breakout to not quite new all-time highs, but pretty close to it. Gets slammed right back down, big slide the next day. So, have to be careful. Here's another one right here. That was closing on a new closing high, and then it got slammed over the next couple of days. So anything can happen, of course, but we would rather see a breakout today than testing down at the bottom of the range, of course. So all good, all good. QQQ. This one has not been as happy or as robust as the S&P 500. But I think if we do that, we will see that on a pivot price basis, we are breaking out today, barely. And I have to say the QQQ has a little better volume than the S&P 500. We're not quite as far below average as the S&P. We've got the stacked MAs. The LRC is in a nice sustainable uptrend. The market bias has just shifted today to dark green. That's a strong trend. All it looks good for more upside. But again, we've seen these moves before. Big green stick, right? 3 days later, right back down again. Got all the way up to near all-time highs, several days of downside. So market's still a little bit skittish on holding to new all-time highs. And we won't get to new all-time highs till we get up somewhere near 504. And here we are at only 492. So we still have some work to do. And CPI, PPI are on tap starting tomorrow morning. Small caps have been the lagging index. This is, as I've said many times, a very messy chart. It's starting to look a little bit better. We've got the stacked MAs. That's a good thing. The market bias is uptrending and in a green mode, at least a light green mode. That's a good thing. But really, all of this right in here, you want to talk about an area of consolidation, an area of non-trending, choppy trade, hard to trade action. That's what all of that represents. And we've seen it before. When it got up here to new 52-week highs, it went into hibernation. Big green sticks up, big red sticks down. Couldn't break up through the resistance trend line. and we have been in a near-term downtrend ever since. So small caps have a lot of work to do. Not holding my breath. We are taking profits from this index using a wheel play, and we're currently, because of the drawdown last week, we're currently in a covered call. So we'll need our TNA. We're using TNA for this to get back on track, and it needs to go up about $1.50 or so to get us called away. And that certainly can happen. Tomorrow, CPI could come in nice and cool. Low inflation means, well, it could potentially mean recession, but I don't think the market's going to read it that way. I think they'll be happy to see the Fed kind of back on its heels, much more ready to cut larger size than smaller size, greasing the skids of the economy, and that will be really helpful for the small caps. Small caps love it when the Fed is dovish, when the Fed is really bending over backwards to make capital easier to get and cheaper. And when the Fed does that, small caps are happy. Same with the biotechs, too, for that matter. Still waiting on bonds. It looked earlier today like they were going to make a reversal. Yesterday, nice big green stick on pretty good volume off of the 200 period moving average. And bonds had been in a nice looking rally, even a strong uptrending rally with the stacked MAs and everything pointing higher. And then ever since the Fed cut rates 50 basis points, that's when the bonds started falling. Scratch your head and tell me why that's happening, because it doesn't make a whole lot of sense to me that when the Fed is lowering interest rates that banks lend to each other, that usually translates into a good, healthy run for bonds and lower yields. But that's not what we're seeing. We're seeing just the opposite. In fact, the 10-year yield, from the day that the Fed cut 50 basis points, that was a couple of weeks ago, to today, the 10-year yield has gained 50 basis points, the exact same amount as the Fed cut its federal funds rate. So go figure. All right, let's take a little bit of a look at the gold, which has been coming back in. We're seeing the same thing in the miners, GDX. Yeah, I kind of like this setup here for GDX because I don't think the run in gold is over. Pretty sure it's not. And it will continue to do well as long as the Fed doesn't start hiking rates again. It will also do well if we go into recession. It will also do well if we see inflation creeping back up again. So there are all kinds of ways that gold can maintain a bid. I know that it's been coming back in because I think I read correctly that central banks have been easing off a little bit on their purchases of gold. Maybe they're full up, or they want to buy Bitcoin. That would be great because we're long Bitcoin. Haven't been doing very well with it. But gold miners are set up nicely here to capture another good up leg in gold. They have been lagging the price of gold. So price of gold has gone up faster than the miners are taking it out of the ground, I guess, because you'd think that with the price of gold up at all-time highs, miners would be doing really, really well and just going through the roof. Well, they haven't been. They're back on track. They're back in a trending mode with lots of volatility. So all these dips down to the pink zone of the LRC, down to the 50, down to the supporting trend line, they can be bought because that's usually this kind of pattern here, this up to the blue, down to the pink, up to the blue, down to the pink, up to the blue, down to the pink, is a repeating pattern, bullish pattern, but you don't want to buy at the top. You want to buy down here near the pink zone, and that's just about where we are. All right, so that's gold. Let's take a look at silver. Silver has not been as happy, is nowhere near all-time highs, and right now you have to say that silver is in a trading range, not trending at all. The trend is flat. Obviously, the market bias is showing an uptrend, but just on a pure price basis, you can see it in the LRC. You can see it in the way the 21 EMA is rising above and then below and then back above a relatively flat 50 moving average. That signals trading range. We got up to the top of the range, and I thought, and everybody else thought, that silver was going to break out, and it did give a big move up to 30, a big breakout move on good volume, and that turned out to be a real trap, and it's been downhill ever since. Now we're between the 21 and the rising 50. That's usually, where did my, I lost my stochastics, but I think if we look at stochastics, let's try it over here, we will see that, yeah, so stochastics on a daily basis for silver is down below the 20. It's typically a good place to buy some shares. So just as a very general play, very general, easy to understand and follow trading approach, you use the market bias to determine whether it's trending higher. You watch stochastics. When it gets below 20, you start to nibble. When it rises up to 20 again, you buy in bigger size, and you hang on until it gets above 80, and then you start to sell. If you did that just about every time, as long as you're willing to hold through some drawdown of some kind, you're just about ready to take profits on almost every trade. In a trading range like this. Now, it doesn't work quite as well. In a downtrending market, for sure doesn't work well at all. And in an uptrending market, you can really get trapped. So sometimes an uptrending market, because it's been uptrending, will drop below 20 on the stochastics with hardly any drop in the price. And so you go ahead and buy on the stochastic signal, and then the price makes the real pullback, right? So then you're sunk. So that happens too. So silver, I think silver is ready to have a day, to have a moment, and let's see how we can play this. We can buy SLV, which is simply the price of silver. AGQ is the 2x version of this. You're going to see pretty much the same chart. This shows a little bit more of the downtrend here with the LRC, but it is the pullback after the big explosion to the upside. This is a good way to leverage a movement in silver alone. Another way to play it is PAAS, which is a American mining company that mines silver, and not a real exciting trade. It's very non-volatile, but it is showing a very similar kind of pattern. Didn't get all the way up to test the top of the trading range, but it is coiling up fairly nicely underneath the 21 and above the 50 and above the midline. I want to show you one thing real quick, and that is the ratio of gold to silver. And yeah, well, this chart is not all that informative. It frankly, and just looking at it here with a fresh MACD buy signal below the zero line and a big pop off these deep cut lows, it looks to me, in fact, like gold is ready to rally, not so much silver. So maybe we should go with a gold miner rather than a silver miner. All right, yeah, I kind of think there's our Florida. This is Milton right here. We're here in the Naples area. We're just enough off the coast. We're not having to worry about storm surge. And looking at, this is a cool site, looking at forward wind levels, we shouldn't get anything above about 35 or 40. So not too worried about that. All right, so gold miners, we'll put that on the back of our list on the top, somewhere in our list, and we'll see where that goes. Wanted to show you a few charts, and then we will, I'll turn it over to our group and see what you guys are interested in. So there are several things I like about Microsoft here that almost led me to put our live trading room into a position, and we wouldn't use Microsoft, we would use MSFU, which is the 2x leveraged version, has a lower share price, very easy, liquid to get in and out of as well. But there are several things wrong with this chart. First of all, the LRC is showing a downtrend. Secondly, we do have stacked MAs, but I would have to say that the 50 and the 200 are just about ready to do what some people call a death cross. And that is usually a late signal. It doesn't mean that you should go short. but it often will flag to big money market traders, big fund managers, stay out, right? Stay out of Microsoft until you see that uncouple, until you see the 50 back above the 200. There's plenty of fund managers, even those that are doing more passive investing, have very specific technical rules like that, and they usually use the old-fashioned 250-day moving average crossovers as a go sign and as a stop sign. That would be a stop sign. We're also right at the 50 period moving average today. We're not above it yet. We're below the 21, and as I like to say, usually good things happen above the 21 EMA and not so good things happen below it. So there's all of that, and the other factors that I'm not sure I have this trend line in the right spot. Where did I have it before? Maybe I'm thinking of Amazon. I think I'm thinking of Amazon. Or maybe I'm thinking of the weekly chart. Let me take a look here. Yeah, it's not the trend line, it's the problem. It's that it is forming a rather well-formed inverted head and shoulders top. And I'm going to put the neckline, I would say, right about there. That's maybe not exactly where it is, but that's probably close enough. And I've said this many times about head and shoulders tops. They are a very unreliable pattern, very unreliable pattern. More often than not, what you really have here is not a head and shoulders top. You've got something like a falling wedge. And falling wedges, however, can be bearish. In fact, they are bearish until they break out to the upside. And as you can see, we're not there yet. So pattern-wise, bearish. Trend-wise, bearish. Moving average-wise, close to being bearish. For those reasons, technically speaking, I would stay out of Microsoft, at least for now. It is Microsoft, however. It's the second biggest company in the world, and it is the largest software company, and the software space has a lot of problems, I have to say. They've been a lagging sector most of the year, but there are some really good things going on in that sector, and I think what's going to happen is that it will be we'll see a time of a lot of mergers. All the little guys will get eaten up by the bigger guys, and then the bigger guys will do really, really well. And I think we're moving in that direction. So stocks like Microsoft, Adobe, CRM, ServiceNow, these are the ones that you want to focus on going forward. And I like it, I like it, I like it, just not right now. And the other one is Amazon. Amazon actually looks better. It is a stronger chart, although we're still downtrending with the LRC. We do have the stacked MAs. The 50 and 200 have a little bit of space there. Here's the thing wrong with Amazon, and this is the one with the trend line that doesn't work, right? So we had the near-term trend that broke to the downside a few days ago. It trapped the bears by popping back up inside, and then the very next day comes right back down to the downside. So there's something going on there. Market is really confused about this stock. Today's big green stick is a good sign, a healthy sign, but we're still underneath that resistance line. Former support, now resistance. Volume has been very light today on this run. That's a bit of a concern, and I would not be surprised to see this tag that line and roll right back down to test the 50 period or the 200 period over the next few sessions. So it's still a no-go zone, but I have to say it looks a little better than Microsoft today. A few others I'm looking at, been talking about this one in the room. This is an Indian software play, and it is in the fintech space. I don't exactly know. I went to their website trying to figure out exactly what they're making, and it's I didn't really get it, but I think they are suppliers to the banking industry, and frankly, I think India is probably going to be a very good place to be over the next couple of years. So So this is one I'm interested in. Doesn't have perfect fundamentals, but it does have very good fundamentals. It's got good, solid market surge metrics, IBD metrics, and really, really good growth. And 3/4 of accelerating earnings. That's always a good thing. They went from negative earnings 3/4 ago to very good positive double-digit earnings this last quarter. It does have earnings coming up next week, I think, so probably not a play until then. PANW. So we got into this one yesterday, or the day before. Was it the day before? What was our entry price? 342. Yeah, so it was Tuesday. No, Monday. It was Monday, right off the bat. Bought the dip, which I don't usually do. Maybe I didn't buy the dip. Maybe it was right at even. I think it was very close to the open on the day. It closed the gap and then rallied back down, closed on the lows, and then it was all gap and go the next day. So that looks very good. Two big green sticks. It's not a place to buy right now. It's going to have around 365. It's probably going to get stuck for a little while. Might even recoil off that. And that's one reason why I'm thinking that maybe we only have 20 minutes of trading, so I don't think we'll do it today. But for tomorrow into next week, we might look at banking this one and then putting on a diagonal debit spread. Now, at $360 a share, you'd think that would put a lot of smaller accounts out of business, couldn't start selling puts on something like that, so costly. But when you do the diagonal debit spread with a long put, not too far away from current price, going out a few weeks, that gives you, that really reduces your overnight margin maintenance, and even a smaller account, if you structure it right, can do this really well. If let's say you buy the long 350, going out to, I don't know when the next earnings is. When is it? 14th of November. So it would probably be the first Friday of November. You'd go long 350 strike put out to the whatever it is, the 8th of November, and that is a cost basis for the position. And then you would start selling the at the money strike, probably 360, if it's still around the same price by Friday or tomorrow. You sell this 360 week after week after week, or whatever the at the money put is. You take your $400, $500, sometimes $600 profit from that. I don't know what the long put would cost you, but it would probably be in the neighborhood of $1,000. So $400, $500 of profit each week against the $1,000 loss on the long put, which is your insurance put. And you're only going to have to hold that. You're only going to have cash in your account of about $800-900 to make that position work. Why is that? Because the difference between the 360 short strike and the 350 long strike is a 10-point spread. That's $1,000 right there, minus the premium you get from the short put. And that's all the cash you need to have in your account. Now, of course, you'd want more than that. You can't just put on this one trade with a $1,000 account. But all that's to say, you don't need a lot of free cash to hold a position like that longer term. So that's what I'm thinking about for PANW. It's been a great trade, and it may break out. Very well may break out. TTD has broken out already. So we got into this one a little bit late, right? We could have gotten in down here, but it wasn't on my radar back then. We got in on the same day as PANW, shot up the next day, follow through day to day. Now we're up into the blue zones. We have to be a little careful up here that we don't want to get greedy, but we'll be moving up our stops. And this is another one that we could do the same strategy on. We'll take profits and we'll sell short, say the 115. We don't have too many weeks in this one, so this one would be going out to about the last Friday in October, which is only about 3 weeks away, right? So we'd have maybe 3 weeks in this one. We would sell the 115 strike for next Friday, and we would buy long, I don't know, maybe the 110, maybe the 111, something like that, and let it rip. So there's that, and Let's take a quick look at China. So we did, this is way too late. I mean, we're profitable in the position, but I bought some Yang yesterday on that big gap down just as a way of, there was just too obvious to too many people that the China pump from all of the government money flowing in was temporary and not a permanent solution, and pretty soon the market would begin to price that in. It just happened overnight rather than during the trading day. We jumped on board anyway. I do think there's still some more downside here, maybe down to about 30 for FXI, which should get us to about 5 on our Yang. But we're going to move up the stop and maybe just cash that one out and see where it goes. We're also in Roku, which got off to a strong start, and we're giving a little bit back, today, obviously. So I have to be a little careful with this because these sorts of trades can flip back very quickly. But we've moved up our stop, and we should be okay with that. We're also in Apple with the leveraged version. Big green stick today. This got off to a very nice start. This one looks like it's going to hit 38 just very soon. The very good price momentum, and the market has shaken off the Apple iPhone fiasco for the most part. That's what caused all this down here, right? The sell-off down to the lower levels and rallying right back up again. Okay, so that's all I had to look at with you guys. Let's take a look at what you are interested in. And you have a few for me already. So let's take a look at UAL. United Airlines. Now, a lot of flights are grounded today in and out of Florida. We're supposed to fly on Saturday out of Fort Myers, which is going to get, I don't think they're going to get a direct hit, but they're pretty close. So I'm not sure if we are even able to do that. But just to let you know that there will be some headwinds, so to speak, on airlines for a little while. I need my, hold on, let me do this. I need my stochastics back on there. Let's take a look at UAL again. Okay, so you can see deep bearish divergence. There was bearish divergence on that breakout move, and now even more on the higher high. If I am to put on my divergence indicator, you'd see both of those guys right there. And the latest one has a whole bunch of other indicators showing bearish divergence. So it's not a buy, it's not even a hold. I would go ahead and sell out if I had profits, because that's going to be dead money for probably a little while. And you never know, of course, but that's what it looks like. All right, CEG is coming back in quite hard. It's up in the blue zone. It's even above the LRC. This is not a place to buy it. This is a place to take profits. And if you were not long, you don't want to be long. You want to wait for this to come back in and do its thing. So 250 is probably about where it would be pulling back to, tagging the 21 period moving average. And then you're going to need to see a good reversal bar. This, of course, is a bullish chart. There's nothing bearish about this overall, but you're going to have to wait to get in until it has finished discounting whatever it's discounting here. So give that a few days and let the dust settle. Look for a tag of the 21 period moving average and then some kind of a reversal. And you can go down to like the 2-hour chart and you can buy a green hammer candle or something like that on the 2-hour. Sophie. Yeah, so I know I'm showing bearish divergence here, but usually these can be deal breakers, right? So every time that showed bearish divergence, it did sell off for a couple of weeks. And we're right back up here again, but this is a pretty weak signal. Only the, what is CMF again? Money flow, the money flow index? Anyway, it's looking like it wants to come back in. So there's also a bit of a trend line resistance there. Yeah, that's a pretty significant trend line resistance. And it's right up there again. Everything's uptrending. It's not stacked MAs, so this clearly has some longer term issues going on. But recent volume balance has been good. And yeah, you don't want to buy these guys up at the top. You want to buy them down here on the pullback, especially a stock like this. There are plenty of good companies. They're ranked up at the top of the IBD leaderboard. They're in the top 50. They have great market surge metrics. They're best of breed and so on and on. And those are the guys you can buy at the top on a breakout or get in on a consolidation near 52-week highs. Perfectly fine to do that, but not a stock like this one. I don't think this even has earnings. Affirm. So this is a little better, right? You are in an uptrend. You just barely have stacked MAs. You've got the, not the death cross, but the, what do they call it? The golden cross here with the 50 climbing above the 200. And as I said, that's not a signal in and of itself. It's just something that big professional money managers will key on and would often be a marker for them to get back into a position. So that could be leading to some of this big volume. Yeah, so here's the thing. This is a good illustration of my rule about earnings. When you get a big pop on earnings, that's a very good thing, very, very bullish. It's the market revaluing the company at a much higher level. The market is saying on this earnings right here that it's no longer a low $30 stock, it's now a high $30 stock. It got off for a couple of days, came back in rather on lower volume, tried to fill the gap, and it could not, and that's another bullish sign. So when it gets down into the earnings gap, you kind of have to hold your breath for a little while, because if it closes that earnings gap, then all bets are off, and it's not a good look. But if it keeps that gap open, which this one clearly did, you can jump back in on something like that right there, that pullback, you can jump back in. Big rally up, this is why you don't want to buy the blue zone. Big reversal there, back down into the pink, the salmon zone of the LRC and the midline, coiled for a couple of days, and now 2 big days up. This is good. It's probably going to go higher from here, and probably the top of the LRC. Now it's at the 43 level, and if it gets up to 49, you know, that's a pretty good move, right? That's 15-16%. So there are better trades out there, but I like it. I like it. Let's take a look at oil. So big reversal yesterday. Everything is downtrending. In my mind, energy is not a buy, it's a short, and it's been a short all year, frankly. So it's a kind of chart, and I'm not just talking about oil. I'm talking about the oilers and the drillers and the distillers and the refiners. All those companies that distribute oil, they are in sell the rally mode, not buy the dip mode. Now, if you like to play mean reversions, which I sometimes do, you can buy down here in the pink zone, and you would be getting out at the midline, right? That's about all you can hope for on the bullish side. This is an unusual rally, and it was based on rising tension in the Middle East. That's likely a short-term issue, and so I don't think oil has legs. If I had profits, I would be out already. Okay, you're reversing here at the 50, the 200, sorry, the 21 period moving average. It could potentially technically set up for a little bit of a pop, maybe up to 30, but really, that downtrend is just too strong. I could be totally wrong. We could be totally at the end of the rally. I'm sorry, at the end of the downturn for energy, but I don't think so. Now, here's the other factors. The election is coming up. I would assume that Trump is going to be more pro traditional forms of energy than green energy. And so you're likely then to see, you probably see the moderation in oil because you're going to see more production, right? More drilling. But the guys that distribute oil might get a real boost. All right, just a thought. All right, I'm going to let you go, guys. That looks like about it. God bless everybody. Have a great rest of the afternoon. Pray for us down here in Southwest Florida. We should be okay. Not going to get the direct hit of the hurricane, but we are getting a lot of the side stuff that's not much fun. But anyway, we'll work through it. If for any reason I'm not online tomorrow because the power is out, then I will check in by phone. And if it's out for more than a few hours, we'll probably jump in the car and head over to Miami and stay in a hotel for a couple of nights. So we'll be back online one way or the other. God bless everybody. Have a great rest of the afternoon, and we'll see you back in the room in a little bit. Bye for now.